Good afternoon, I'm Brigid Taylor and this is Currency Wars. The Bank of Japan has kept its stimulus program intact in the wake of data that showed that the economy in Japan is in recession. That's with GDP growth contracting 1.6% in the third quarter. Japan faces structural issues as well as weak exports, which also contributed to that contraction. Meanwhile, in the Eurozone, ECB's President Draghi reiterated the point that the bank was ready to take more steps to support the Eurozone recovery, with other members warning of a downward revision in the growth estimates in December. These comments and the data will cement Japanese yen and euro positions as funding currencies for the carry trade. This is an important anchor for emerging markets such as the rand, which are still facing domestic risks. Meanwhile, in South Africa, CPI remained unchanged at 5.9% year-on-year in October and remained within the 3.6% target band, as food slowed notably and fuel inflation remained subdued. Meanwhile, today is the SARB's MPC decision and we're expecting an unchanged interest rate, with more than enough justification in terms of both domestic and external conditions to allow for the bank to ease up on its hawkish stance prior to the meetings. Right, now that we've seen the lay of the land, I'd like to welcome my guest host today, Cilliers from Treasury One. Welcome, Andre.
Thank you.
We've got MPC today, so all traders waiting in anticipation, I think, to see whether or not our MPC's changed its stance now that we have a new governor in the reign. So what are your views with regards to the outset with all of this news and data, specifically around, the ECB, Draghi's decision to potentially try to stimulate the European zone? We've had monetary policy statements out of the Federal Reserve yesterday. We've had the Bank of Japan coming through with some statements around also stimulating their economy. All of these noises in the economy from a global perspective and the impacts that you expect today in MPC.
It's been an interesting 2 weeks. I mean, let's go in the last 2 weeks, apart from what you've mentioned, we've also had the downgrade of South Africa. Mm-hmm. And what was really notable at that stage is that with the bands that we always predict here on Currency Wars, that we broke out a little bit out of that band on a very temporary position, came back very quickly. And I spoke to a lot of people and sort of cautioned them that the only reason why it broke out was at the same time the euro had actually collapsed quite considerably after also what happened in Euroland, as you mentioned.
And it's been interesting because, I mean, as you mentioned, we had all this negativity around, both the global picture and the South African picture. Yet, yes, you're right, we broke out above the band that we thought we were being quite conservative about. But it was only really about 3 cents to the top side of that. So it was really negligible in terms of the top side, but we did see a pullback thereafter. Maybe you can talk to our viewers and investors about what happened post that and why we're seeing Rand now sitting comfortably around the 11 level again.
Well, post that, we mainly focus on Japan, that is now officially into recession. Mm-hmm. And the Eurozone, as we've mentioned in the beginning, you've mentioned that they are now sort of also cautioning about slower numbers in December. Yeah. And the impact thereof throughout the world, through into the US. We know that China isn't doing well. Back to South Africa this afternoon with the MPC, the impact of that is that we're also going to focus on growth. Yeah. We have to. Yeah. Our growth is very slow.
And inflation's not such a big issue anymore. I mean, if we look at what's happened with the oil price trading around $80, that's significant in terms of our projections around inflation with the Rand at 11.
Well, we speak about real interest rates. Now, there's two ways of getting to real interest rates. Or you have inflation coming down or you have interest rates going up. We look at the fuel price at this stage, that's somewhere in the order of 70% over recovery, 70 cent over recovery average for the month. So we can expect a further decline of the petrol price, which we've had in the last 2 months.
Which will be welcome for our guys that are doing a lot of logistical trade.
And that will filter through on the inflation side. And if that filters through on the inflation side, we can expect lower numbers, brings us closer to real interest rates, real positive interest rates. And no pressure at all at this point in time on the Reserve Bank to increase interest rates.
But even if we look at the, if we're talking about real interest rates, we're talking about people that are funding out of South Africa, investing in South African products. So that's the real interest rate. However, when we're looking at foreign investors investing in South Africa, they're funding in the likes of the Eurozone or Japan, which is what we talked about earlier with regards to them becoming the carry opportunity that is the funding currencies for the likes of South Africa. So, we've seen those continued continued inflows as a result of commentary out of the Eurozone with regards to potential increase of stimulus, with regards to the Japanese central bank potentially not increasing their VAT, keeping stimulus measures in place because they realize that they're going into a contractionary phase. Those concerns obviously are driving funds in the short term into the likes of South Africa. But the bigger concern in terms of our imbalances is really around, how do we export in this market? If we look at the Chinese PMI today, it was disappointing. And that's a concern because it is one of our major trading partners. So I think fundamentally from a South African perspective, we're still on the back foot. However, it's not playing into the interest rate. So, what is your view around those underlying fundamentals versus what's happening globally and how that's going to impact the interest rates and the currency specifically?
Okay, the underlying fundamentals, and we've spoken about a lot about that still remains very negative. And that still will, over that time, influence the rand, but I think the drivers would be the carry trade. So people looking towards a currency weakening to assist them in their exports is looking towards the wrong avenue at this point in time, as far as I'm concerned. They would have to start looking at being competitive rather than looking at an exchange rate to assist them in their proceeds.
And also, if we don't see the demand from offshore anyway, if that demand's dropping anyway, then there's that caution around whether or not your exports, even at these levels, have any value.
Brigid, yes, but we should also start looking at other than our traditional markets. There's huge opportunities in Africa. So, we should stop looking just at Europe and Japan and America.
Agreed.
We should look at other avenues of exporting and marketing our products.
Agreed.
To increase our export levels, rather than just looking at the traditional markets.
And especially in the markets that are close to home. I mean, as you mentioned, the African markets are growing. There is that sustainability. There is that demand coming in from those lower and middle class sectors. So yes, you're right. However, let's talk about in terms of when you're looking at the currency and it playing off. So if the currency remains at relatively low volatility levels, and then you're investing in the interest rate, there's a bigger drive in terms of the interest rate because you're not offsetting that gain that you're getting on the interest rates, losing on the currency. So that double whammy that we're currently seeing for foreign investors, that continuously keeps our currency within stronger bands relative to the underlying fundamentals. Do you think that that's going to play into the hands of where we see the ranges going forward in terms of where do you see the risks as we go into this next chapter in 2015?
Well, if we get into the next chapter, 2015, as I mentioned, carry trade is going to be with us for a long time. Stimulus packages is going to be with us for a very long time, and we will continue to benefit from that. Investors, and I've said this on previous occasions elsewhere, I don't want to save my money for 25 years and then end up sitting in Europe earning 25 basis points or paying money to have my money in the bank. So I'm going to continue looking at, if I'm outside this country, looking at places where can I invest that I will actually have returns.
Yes.
Going back to what we spoke about inflation, as long as I get an interest rate here and I do not spend my money in this country, I'm not really too concerned about the inflation. I'm getting 6%. And if I get 6% and my inflation in my own country is virtually zero, then I've done pretty well. So we should look at continued inflows into that market. Gives us time to address imbalances that we have locally, and I certainly hope that we will be doing that.
But then that's the key, and I think that's it, because we're basically in the same movie as we've been in 2014, because we hoped in 2014 that we would start to see a growth curve that had a little bit of sustainability. So we started to see it out of the US. However, the Eurozone and Japan specifically, and now China, puts that pressure on the United States, who's starting to show some forms of growth. So it looks as though it's pretty much the same into 2015. However, as you reiterated, then the concern is how do we address the underlying fundamentals that are unchanged in South Africa, especially if we're going, if we look at the budget statement in February and what we've seen out of the ratings agencies. What is your view around their concerns around those structural imbalances?
Well, we'll have to wait and see what happens in February now with Mr. Nene's budget speech. But I would certainly hope that our spending would be under control. I would certainly hope that salary increases in state departments is under control. It's interesting to mention here that if you look at salaries being paid in state departments and average salaries in the private sector, it's becoming very lucrative to rather work for government than private sector at this stage.
Well, that's
so that needs to be contained. You know, we need to get that under control. If that's under control, our budget deficit comes under control, our borrowings come under control, our interest bill comes under control.
And that helps with our imbalances.
That helps with the imbalances. Okay. And then with carry trade continued, we can look towards a pretty nice, stable 2 or 3 years.
Yeah.
Because the world is not going to come out of this subdued growth phase anytime soon.
Now that we know where we stand and the risks and opportunities, we're going to pull out the big guns. So, Andre, let's talk about real levels. So let's talk about actual trading levels. Let's look at pound rand, let's look at euro rand, and let's look at the dollar rand. What is your view for the week ahead?
View for the week ahead, dollar rand, I would call it between 10.95 and 11.20. The pound rand was the one that surprised me a little bit. That came down a lot more. I would call that 17.30 to 17.50, and euro rand somewhere between 13.80 and 13.95.
So in conclusion, we are expecting to see the rand dollar continue and to remain around those 11 levels. Not a lot more strength expected according to Andre, looking at about 10.95 on the bottom and looking for about 11.20 on the top side. However, the real strength has come through on the crosses. We're seeing opportunities with regards to the pound rand, which is expected to trade between 17.30 and 17.50. And on the euro rand, also continued strength below that 14 level, down at around 13.70, 13.80. Please send your comments and your questions to CNBC Africa, #CurrencyWars410, or to myself at Brigid R. Taylor for your personal responses to the FX markets. Until next week, good luck in the trenches.